Welcome back to Squawk Box. Private equity firm New Mountain Capital just sold its stake in accounting firm Citrin Cooperman to private equity giant Blackstone. For more on the state of deal making, I want to bring in Steve Klinsky. He's the founder and CEO of New Mountain Capital, private equity firm with now more than $55 billion under management. Steve was also one of the co-founders of Goldman Sachs' private equity group back in the 1980s, one of the OGs. How are you, sir?
Fine. Thanks for having me.
We've all been trying to understand sort of where private equity has been. There was a sort of slower period, whether we're sort of shifting out of that at the same time that we have this new administration where there might be a lot more deal making. Where are we really?
Yeah, I mean, I think private equity has been a very good asset class for many years now. I've been doing it, like you say, since the early 80s. It's outperformed, you know, over kind of any period of time with less volatility. Deal volume has been slow for the industry generally. My firm's done well, but I think that's going to pick up. Most people think there's going to be a lot more deal volume.
But there's also been a lot fewer exits.
Well, that's the other part of deal volume. And again, my own firm's had a good record of it, but the industry overall, and I think just deal making in general has been, you know, held down for the last few years. And there's a lot of belief. I was just with one of the heads of one of the major banks, and the backlog of deals they think they're going to be selling is way up.
But do you think that's a function of? Do you think that's a function of a view that the regulatory environment will get easier for? But that's for big strategics for the most part, I imagine.
I think, you know, again, I'm putting my own firm aside, which has been very steady. It has been a repressed deal environment. I think the whole deal environment, not just the big side, is expected to bounce back.
Kind of situation.
And its interest rates have stabilized. The regulatory environment, I would say, has been pretty hostile to M&A.
Right.
People hope it will be less hostile. And I think there's some kind of repressed animal spirits.
What about the fundraising world? And the reason I ask about that is, in part because there have been so few exits.
Yeah.
A lot of the U.S. pension funds specifically, they're out of cash. They have no money to give to anybody. And then everybody makes a pilgrimage to the Middle East. And you can even argue they're starting to try to spend more of their money in the Middle East itself.
Yeah. Well, again, for my own firm, we've raised a fund last year that went very well. I think the key to private equity is there's still plenty of money. It's a $5 trillion asset class. The real message about private equity is, are you a value-added institution or not? And the key is to be a firm that can prove to the LPs, who are very sophisticated, you can actually build businesses, do something, not just lever an index. And I think there's plenty of...
Meaning being great operators, helping...
Yeah, I mean, to me, the 40-year story of private equity, because I'm one of the original people since '81, is it's gone from a form of finance to a form of business. I mean, when I was with firms in the '80s, we had 5 professionals, and you're borrowing a lot of money. My firm now has 250 people. You know, on Citrin, which you mentioned, we used no debt at all when we bought the company. And so it's a question of the LPs are looking for, they don't want to all be in the stock market with all their money and tied to a few tech stocks. So how do you diversify? How do you have groups? And there's 5,000 private equity firms. So which ones can actually pick the right company, build it, sell it, do the right job?
So and it's not about levering up.
It's not about, I mean, there's still leverage as a sweetener, obviously, but it's not leverage. It's not your granddad's private equity firm from the 80s. And if you are, you're not raising any money. So the key is to be a value-added institution who can prove that. And some of that is getting exits done as well, which is part of the
There's a shifting model in play, that's a shifting model issue, which is, you know, you have folks like Blackstone and others who are starting to think about, you know, how can you turn this into a retail product, right? And then there's the Apollos of the world, which effectively are trying to create sort of this sort of permanent capital kind of structure or insurance-like structure. Where what do you think of that, and how that will sort of impact all of this? Well,
there's a couple of questions in there. One is multi-asset class firms. So Apollo was known originally as a private equity firm. I think today I don't want to speak for them, they may be thought of more as a credit shop or an insurance firm, which they still do private equity. And so my own firm, for example, has a credit arm as well, a real estate arm as well. But the key is to use those same value-added skills to really understand a business. If you don't buy it, you can lend to it. So I do think multi-asset class makes sense. On the retail side, I mean, private equity is a very good asset class. I think it could make sense for retail, but I personally believe you have to be very careful about it and make sure that someone doesn't get telemarketed by a firm they never heard of and just give to a fly-by-night firm. So the groups like in Australia, you have Aussie Super, in Canada, you have the big gatekeepers that protect retail investors, because it is a very sophisticated decision to pick one private equity firm from the other.
We keep talking about how the regulatory environment may get better for sort of the big strategics, but one of the other interesting features of this, at least last administration, was regulators have started to look at deals put together by private equity firms doing roll-ups and what that looks like, especially in the healthcare space and other places where people say, you know what, they get worried that people are getting squeezed in different places.
Yeah.
Do you think that continues?
Well, I think, again, the last administration, not just about private equity, I think if you talk to kind of any business group, they will say there was a lot of hostility on the antitrust side and distrust of business generally. As far as roll-ups, again, there's good ways to do them and bad ways to do them. McKinsey just came out with a study I saw where, you know, if you have the best player in a space with the best cost structure and the most efficiency, and they buy up the little mom and pop and make it more efficient, which is a lot of what roll-ups are, that can be very, very good. So it's not a question of rolling things up to, you know, dominate markets. It's more often having a great business model you're trying to expand. And also, the roll-up is if someone builds their family business and wants to sell it at the end of the day, I mean, that's who they sell it to. So, and plus, it generates a huge amount of tax revenue for the government and stuff. So I think, you know, there's just been a lot of distrust about business generally, and kind of it feels like animosity to business generally, which I hope will be less in the new administration.
Steve, it's nice to see you. Thank you, sir, for coming in.
Thank you very, very much.
Thank you.